Well, it is indeed the last panel of the day, so we're not the penultimate, we're the ultimate panel. I think that, we've talked a lot this morning about the problems in the developing world, and some investors are increasingly looking towards the emerging markets. And it's great that we've got a fantastic panel here to discuss some of these issues. I'd like to, first of all, turn to you, Christopher. You're the CEO and founder of Macro Advisory Limited. Could you tell us more about your current work in your business and your relationship with the emerging markets?
Okay, thank you very much, and thank you for the invitation to speak today. Obviously, this year has been quite a different year because I have been based in Moscow for the last 25 years and covering the Eurasia region there, and certainly since the start of war. I mean, I can use the word war here, I can't in Russia, but since the start, we've seen more interest spreading to other parts of Eurasia region, to Central Asia, to Caucasus, investors looking at, what is the impact on those, I suppose you call them frontier markets, very early stage markets, and the overall impact. So we work with strategic advisory firms, that's private equity, sovereign wealth funds, typically funds that have got a kind of long investment outlook rather than short-term trading or even mutual funds. So we work on due diligence for those funds, help them understand deeply into whatever asset they're looking at or situation, and with a view that they're making an investment for a longer time, riding out the volatility. So this year, we've definitely seen the focus shifting towards Uzbekistan and Kazakhstan in particular. And actually now, the last maybe 6 weeks, a lot more due diligence requests for Ukraine post-war. People are beginning to look at what might happen there. But there you go.
Interesting. You have lived in Bangkok, I think, and you were also formerly in Abu Dhabi with Adia.
Yeah.
So this is like a sort of homecoming for you.
Yes, I was in Adia in the 90s and on the asset management side, and went to Bangkok for a couple of years before finding myself in Moscow and wondering where the sun had gone.
And secondly, I'd like to introduce Andreas Vogelsanger. You're the CEO of Asia Frontier Capital Vietnam and the founder of AFC Vietnam. Could you tell us more about those funds and your business there?
Sure, we have quite some interesting funds. I founded the AFC Vietnam Fund, which is basically just investing in public equities in Vietnam. But we also run the Uzbekistan Fund. Then we have Iraq Fund, and we have an Asia Frontier Fund, which is investing in 12 Asian frontier markets, such as Mongolia, Papua New Guinea, Laos, Cambodia, and so on. So all the fancy places which are up and coming.
Fantastic. Thank you very much. Mark, I was very intrigued by your objectives at Lendable. You're the head of global capital markets. Could you tell us more about your business at Lendable?
Yeah, sure. It's a bit of a niche play, but so at Lendable, we're a tech-first, frontier emerging market fintech debt investor. And I know that's a bit of a mouthful, but essentially what we do is we use our tech to work with early-stage fintechs and take them from not being able to access institutional capital. Through the use of our technology, we can then bring institutional capital into those fintechs in emerging markets to help them really grow and expand.
Thank you very much. Thank you indeed. Now, the phrase emerging markets covers a whole lot of countries. I think it's normally taken conventionally to be the countries in the MSCI Emerging Market Index. Christopher, could I first of all ask you the big question? Within this huge disparate group, where do you see the opportunities are now particularly? And if you could tell us a little bit more about why.
Okay, well, I think it's terms of the kind of the interesting themes, and bearing in mind, obviously, the region for me is Eurasia, but also it covers Turkey and Iran and I guess the countries around the Eurasia region. And here, I think the last couple of years, obviously, since COVID, it's had a big impact on what investors are looking at. We've seen a lot more interest in, I suppose you call them just more basic industries like, say, transportation and logistics. Obviously, that's a big investment theme in this region. Renewable energy, of course, for sure. See, Uzbekistan, they have attracted a significant amount of money into renewable energy. I guess it's geography and the other available options. But Abu Dhabi government, for example, has a joint fund and has been a big investor through Masdar and Mubadala in renewable energy, and is now branching out into Kazakhstan and countries around the Caspian. So, and then healthcare. I mean, again, healthcare in sort of the Eurasian region is not that developed. I mean, it's fairly basic. And I include pharma and medicines and all those related areas. But in the last couple of years, it's really become a lot more of a priority for governments in terms of budget allocation. And we do see very fast growth, population growth in some of the countries in Central Asia. So healthcare, so those three sectors. One last thing I would just point out, of course, this year, because of the disruption, because of the war, and as everybody's aware, there's been a big exodus of Russians, those who can move. And typically that's been IT specialists and technology. And you're talking about anywhere between 250, 400,000 IT specialists have gone to neighboring countries. So, the IT sector, I think the previous panel talked about outsourcing, Poland, Ukraine. Russian IT specialists have gone there, but also to places like Armenia and Georgia. So it's kind of themes are beginning to emerge in pockets. So it's not a case to say, you should just put all your money into Armenia, you'll make lots of money. You won't. But if you put it into, scientific development and IT, you probably will. So it is selective in that area. Yeah.
But I mean, just to look at the whole universe of emerging markets, we've got Latin American countries. You've got this huge disparity, if you look at MSCI, between, let's say, China, India on one hand, and then you've got Greece and Ecuador in the index. Andrea, could you perhaps try and generalize a little bit about any common features in this quite disparate group of locations?
Well, it's interesting. We are obviously focusing on frontier markets. So MSCI has different categories. Now, frontier is the very beginning, then it moves into emerging, eventually developed markets. So yes, for example, in its infancy, when you look at these frontier markets, they have pros and cons. On one hand, you have, when we manage these funds, our top risks, which we need to manage and mitigate, are corporate governance risks and liquidity risks. And so these are the way we do it. For example, in the Vietnam fund, we just spread, we over-diversify the way we invest, and we don't have any concentrated bet. Should there be a balance sheet fraud in one of our companies, the impact on the overall fund is not that big. But also for liquidity, you can easier buy and sell without having a too big market impact. So that's probably issues which we have in frontier markets that is very difficult to mitigate these two risks.
Right.
And when you move up the value chain, you go into emerging markets, of course, the liquidity is less of an issue, maybe still, occasionally it varies. And also it's an evolution process. If you look at corruption, for example, there's a corruption perception index, given that you can't measure it very exactly, but the tendency is that you have less developed economies having higher corruption than more developed economies which are less corrupt. So, for example, in Asia, Singapore, of course, is the role model with very little corruption. But then on the other end of the spectrum, you have Myanmar, Laos, Cambodia, which are really the corruption is on a quite high level. So in the middle, then you find like Thailand, Vietnam, Philippines. So that's where we are operating.
I mean, it's often characterized, I think, as an area where there's growth and stocks that will give you diversification in a portfolio. Would you buy into that? The growth factor and the diversification factor make emerging markets interesting?
Yes, look, it's of course we're probably going to face a recession in Europe and in the US, so that will have an impact on global economies. So higher interest rates, inflation, higher commodity prices, increased geopolitical tensions. That's all the same for everybody, I guess. But then in Asia, despite the headwinds we are facing, you still find economies which are growing over 6%. So Vietnam, for example, this year is expected to grow 8%, and next year, despite all these negative factors, still around 6.5%. And so is Bangladesh, for example, another example. In terms of diversification, it's yes, for example, Bangladesh is a good example. Now, if you look at the correlation to MSCI World over the last 10 years, Bangladesh has only a correlation of 0.06. So extremely low correlation. So frontier markets or emerging markets in Asia surely will add to the diversification benefit in a portfolio.
Right, thank you very much. Mark, where would you see the bright spots in the emerging market universe at the moment? Perhaps Brazil with Lulu getting in, or China with a recovery scenario, or how do you?
Yeah, it's a great question, and with Brazil, it's the firm view that we're waiting to see. See how it all plays out, because obviously that's only recently transpired. So any change, and we've seen across Latin America, actually, there's been more of a trend towards socialist governments there. But we're invested across Latin America, Southeast Asia, South Asia, and Africa, across many different regions there. But within those regions, there are pockets of great opportunities, and then there's pockets of places where you actually just can't get access to. So there's a place like Nigeria, where it has great demographics, it has a burgeoning fintech system. They're really changing the game there in what they can do. But because of what's happening with their currency, you can put money in, you just can't get it out. And as an investor, that's kind of one of the things you want, is you want to get your money out. And so, whilst it has the commonality of other places where, and this is something we see across a lot of across a lot of emerging markets, where the traditional brick and mortar banking establishments in these markets, they have great ROIs, which you think doesn't sound like a problem. But because they have great ROIs, what's meant is that they've, to use a kind of loose term, they've gotten fat. Mm-hmm. They've gotten fat and lazy in terms of serving their populations. And so what that's meant is that it's created this environment for all these fintechs to come in and thrive in all these markets and kind of come in and cut their grass. And we've seen that's what's particularly happened across a lot of emerging markets. Indonesia, Kenya is a great example, where pre-2007 it was purely cash-based, and then M-Pesa came along, and they were founded by one of the telecoms there, and within a year and a half, I think 90% of the population's using it. And off the back of that, from 2007, they now have one of Africa's best burgeoning tech sectors and fintech sectors. And so, yes, we're seeing those pockets are still out there, and they're still existing.
Right. Christopher, we've touched on this, but could you generalize in terms of any headwinds in the emerging market economies? They've actually done worse than the developed markets in the third quarter.
Sure. Look, I think the headwinds, there are some very obvious headwinds. Clearly, the fallout of the war in East Ukraine. Clearly, that has reduced the appetite for risk in lots of funds, and it's difficult to generate interest in frontier markets, fringe markets. For funds, it's easier just to invest in US dollars, and we've seen obviously that over the last couple of years, and with global inflation as well and rising interest rates, the natural default for big funds always is to run for safety. So we are going to need some improvement, I suppose, in those headwinds, the geopolitical risks, some clarity perhaps on energy, and a peak perhaps of interest rates.
Yes.
Then I think, always that leads to more interest in risk taking. It leads to more interest in emerging markets, frontier markets, and we're not there yet. So I mean, there's just that's the major headwind, is the uncertainty.
Right.
In emerging markets, you need two factors to invest or to attract investment. One is the economic predictability, and the other is political stability. You lose one or other, then you're not going to get the money. And so the domestic political factor is also an issue in a lot of emerging markets. I mean, I like Turkey,
Yes.
a lot of some interest in Turkey, but obviously major political issues coming up with the elections next year, and then the politically driven, impact on central bank policies, again, which affect currency, capital flows. But within that, there are some very strong companies and some strong export-oriented companies, some strong growth companies. So I think the main messages in emerging markets is you have to be selective. I would not be comfortable saying put all your money into whatever, Nigeria, Vietnam, we've mentioned Uzbekistan, but there are pockets and themes in all of these countries that are very strong, and I think that's what investors increasingly, probably next time around, say it's different this time is always a bad way to start any sentence in a financial context, but I think, the fallout, remember the headwinds started with COVID and they've just got worse in this period. So it's been a long period of, battering risk assets, and I get the sense that investors, when they return, will certainly they won't be looking so much as geographic or maybe not even country specific, they'll be looking at themes and how those themes fit into the differences in the world we have today.
And Andreas, could you, I've just listed one or two. I mean, there's economic risk, obviously, unregulated markets perhaps, and unsound monetary policy, so economic. You've got currency risk in some of these countries that you might well be exposed to, and of course the political risk, as potentially, as Christopher mentioned. Could you?
I just would like to follow on what you said about geopolitical risks. Of course, it's not for everybody the same. You have, for example, the zero COVID policy of China, which is forcing companies like Apple to think about different production hubs for their products, and they have chosen India and Vietnam, for example, to outsource now because they can not just afford to have delays on their iPhone 14 now, just because of these kind of issues. But also we see now big investments in computer chips in Vietnam. So Samsung is investing over $3 billion to produce a manufacturing plant for computer chips to reduce dependency of Taiwan. So that's obviously an issue which we are all facing. So there are winners and losers always in that field. And currency, you mentioned currency risks of the strong dollar has an impact on global currencies, I think. Even the Swiss francs, I'm from Switzerland, it devalued 9% as of the end of October versus the US dollar. And the Vietnamese dong, 8.8, so roughly the same. But if you look at Sri Lanka, lost like 80%, of the value. So obviously that's a little bit a special situation there because the de facto bankrupt without the IMF. But and Pakistan also had massive issues during that year with the floods and everything.
Mark, anything to add there?
Yeah, the currency risk is huge. It's we see what's happened with in particular places like Egypt as well, where a year ago Egypt was a perfectly fine place to invest from a currency risk perspective, and that's now I think that's 60-80%, something like that, the depreciation, and that's only just gone to float now. But then there's other regions, and it's really funny where everyone's driving towards the US dollar at the moment, and that's that's no secret, and that's why all currencies across the board are all weakening against the US dollar. But in places like Indonesia, the currency is weakening a bit, but the actual economy and the risk spreads on debt in Indonesia is actually reducing.
Right.
And it's because you have these pockets where there's actually excess liquidity within their system, and that money needs to be put to use somewhere. And there's not enough opportunity for that money to be put to use within those systems. And so you're creating these pockets of liquid countries where there's too much money slushing around and the returns are actually reducing at a time when central banks are putting rates up.
Right.
Yeah.
Right. Thank you. Christopher, I'd like to ask you this question. If you look at how much money you should invest in emerging markets in a portfolio, you can do it on GDP, you can do it on market capitalization, you can even do it on some portfolio optimization process. In each case, it comes to about 25, 26% of exposure. Mm-hmm. On average, institutional exposure to emerging markets is about 8%, which is the famous home bias, isn't it? Could you comment on that and how justified this statistic is?
Well, I think clearly it depends on the fund and what the focus of the fund is, and what its ultimately what its purpose is. So if you look at a pension fund with long duration or a trading fund, and that's so for the longer the fund, you can afford to take emerging market risk and ride out volatility in order to get superior longer term returns.
Right.
There you absolutely should be closer to 20 to 25%. On the other hand, if it's a fund with a shorter duration focus where you might get drawdowns, etc., then you can't afford to have more than 10%. Mm. So it's always a case of when you're investing is, well, when do you need the money back? And can you afford to wait to ride out any volatility? But I think in general, unfortunately, we all remember the bad times, and we remember the emerging market volatility and the currency crisis and the political crisis, and it takes a long time for that memory to fade, and it tends therefore to push towards a much greater conservative and conservatism. But in general, if you ask me, just taking the emotion out of it, I'd say if you're a long duration fund, have 25%. If you're a short duration, less than 10.
Right.
Unfortunately, people tend to be less than 10 because of all the headlines.
So the home bias is there.
Yeah. It's interesting, especially when you look at these emerging markets and frontier markets. Some of these countries have actually built up significant foreign reserves. So they'll learn, especially in Asia, they'll learn from the Asian crisis. So their balance sheet is actually has improved and arguably better than other regions which we see currently. So I guess these economies, also when you look at government debt to GDP, so you have, for example, Indonesia, Vietnam around 40% level, then you have Thailand, Philippines around 53% level. So that's still quite reasonable, I would say, even though these countries, they need to invest a lot in infrastructure continuously, because they obviously are constantly improving everything, building airports, undergrounds, and so on, so on, and so on. But they manage their households pretty well, I would argue.
Sure. Well, we're coming to the end. Mark, I'd just like to ask you one extra question, and then we've got a slight bit of time for questions from our audience here. Yep. Where is going to be the next super frontier market, the bombshell? Mm-hmm.
Yeah, I think, so a place like Andreas mentioned, Indonesia. Indonesia's just woken up, and I'd lived in Indonesia for about 10 years. And when I'd moved to Indonesia, I'd moved from the US, and people said to me, oh, is Indonesia that island off Bali? And that was the perception at the time. And last week, Indonesia hosted the G20, and it's where the Biden-Xi Jinping handshake took place, and amongst other notable events. And so now it's the pretty girl at the dance. Everybody wants to dance with Indonesia now, and it has a combination: the infrastructure, the capital flows, the demographics. All those things are coming together for it at the right time. Right. And so, yeah.
Fantastic. What about here? In the Gulf?
Hmm? Well, there's plenty of opportunities. I think you just need to look around.
Are there any questions for our expert panel from the audience? I think being one over here, right. Can we get the mic over, please? It's yeah.
Just curious, how do you exit your investments given the, the lack of capital markets usually in these frontier markets? And also, if you do exit, how do you take the capital out, the money out, given what you've mentioned, Mark, about the currency in Nigeria?
Anyone want to take
Yeah.
it? Do you want to take that?
Yeah.
Please, Mark.
So for us, from a Lendable standpoint, is we do a macro assessment of the geography first, and so that includes the currency. And basically, if we don't believe we can take our money out, we don't put our money in. But on the flip side as well, our investments are only in US dollars, and so it's our underlying investees who then have to hedge that risk. And so in cases they're hedging typically using forwards or put options, and so they protect their downside that way.
Thank you. Thank you. Any other answer? Chris?
No,
Yeah,
nothing sensible to add.
Well, we've got time up flashing now. We are the ultimate panel, not the penultimate panel. Could we give our panel a great hand? And thank you very much. Thank you indeed.
Yeah,
Thank you. Thank you. What's that? Sorry, I didn't hear what that was.
There's one last question.
One more question.
One extra question? Oh, yeah, sure. Yeah, no, please.
My name is Vladimir. I'm from Kiev, and my fund has been investing in Ukraine for last decade. So my question, well, you know that we have a little bit more problems now to face than a rate hike and stagflation and all this stuff, but we keep investing. And every day we think, and this is a question, maybe it's time to assess geopolitics is a new factor for decision making. And maybe our generation, maybe this first time we need to hire more political analysts, more geopolitical advisors to take our investment decision for next 10 years. Thank you very much.
Well, I would say that politics has always been a big factor in the investment process. Because I mentioned, economic predictability, political stability. These are two, critical pillars for investing. And I guess, maybe one of the differences between developed markets and developing markets is that you tend to assume the political stability, or at least the political process. I mean, obviously what's happening maybe in the UK, Italy, leadership changes, but it's still a stable system relative to emerging markets where you have sort of the geopolitical risks obviously affecting Ukraine right now, and we've seen disrupting Brazil and other Turkey, etc. So it's always been a critical factor. I think obviously because of events this year, it is much more prominent, and we've seen lots of political issues, and maybe there'll be more. So definitely, it is part of the process. It's always part of the process. It probably will be a bit more pronounced in the next couple of years than it has been, but it's always been there. And if you're developing in emerging markets, you absolutely have to analyze deeply into the political system, the prospect for political disruption, as much as looking at what the economic trends are.
Very true. Thank you. Thank you.
And interestingly, actually, just in the last couple of months, we've seen a lot of companies and funds starting their due diligence process on Ukraine post the war. So I think that's obviously been a tough year for Ukraine funds, but I would say that's clearly that's a specific play. But the due diligence is definitely ramped up.
Very interesting. Thank you. Thank you very much. Thank you again. Thank you. Thank you.